Hi all and welcome back to another episode of the ICIS Energy Foresight podcast. Today is a different episode, kind of special episode because we're gonna discuss about trading ideas. We always get requests from market players to have them frame the data and the insight that we work on into trading ideas, into ideas that they can apply to the trading floor or the buying or selling activities. So we're gonna deep dive into three different ideas, three different cross-commodity ideas. The starting point is a big disclaimer. The content that we're gonna discuss and present in this episode is purely for informational purposes and does not constitute financial advice. So we are here to help you conduct your own research, frame what happens, but this is not again trading advice. So let's jump into it. Three different ideas, and we start from the first one, which we can call it the transatlantic idea. So the underlying hypothesis is that the TTF and the European gas benchmark is set to fall over the course of 26 due to looming abundant supply, especially on the LNG front, while the correspective benchmark on the Atlantic side, in the US, the area hub, is set to nudge up, so to increase over the course of the next year due to internal pressures, internal demand, which is linked to a few factors, and also to the need, obviously, to become more of a prior reference for new exploration activities. These two opposite phenomena, they suggest that there is a possible narrowing of the spread between the TTF and the area up, which suggests that there is an explicit double positioning, so across both sides of the Atlantic, or across market spread positioning. So effectively going short on TTF, long on the area up, or basically tackling directly the spread between the area up and the TTF. What are the risks linked to this idea? Multiple risks. The first one is the basis risk, which is linked to the underlying thesis being not effectively correct. So TTF actually falling and the area up actually increasing. There is a currency risk, which is linked to the fact that the two contracts are basically dominated in different currencies, the euro and euro terms and dollar terms. And obviously they have their own volatility. And then there are contractual terms and delivery points and all physical elements that obviously might should be considered when obviously trading across different markets. The second idea, which is a cross-commodity idea that plays across gas and carbon, is something that we can call the synthetic clean spark spread. The underlying assumption is once again linked to the fact that there is an expectation that gas prices in Europe, especially the TTF, is set to fall in 2026 on the back of larger supply coming into Europe, while the price of carbon is set to keep increasing in 2026 on the expectation that there is a market tightness on the carbon side in 2026 and 2027. We call it synthetic because in this case you are synthetically increasing the carbon component while decreasing the gas one. Effectively, this is a bet on carbon becoming more expensive relative to gas. And the size of both position is quite critical in this case. And we are here excluding any consideration, obviously, on the power price that could add another element of complexity or opportunity in this case. As for the previous ideas, there are a few underlying risks that need to be considered. The basis risk, which is linked to the fact that the core assumptions might be wrong or might play out differently. There is a policy risk here, which is definitely an add-on compared to the other idea, and the policy risk is linked to obviously carbon being heavily impacted or exposed to policy intervention. There is a correlation flip, which is quite interesting, especially we've seen already in 2025 how gas can actually drive carbon, and this is linked to the fact that there is a fuel switching on the element on the carbon side, and there are all other risks obviously related to external shocks, as we've seen previously for the first idea. The third and last idea, which is probably the riskiest idea, because there's still an element of uncertainty related to the policy proposal underlying this bet, is the what we're gonna call the Made in Italy premium. So the Italian government is currently considering the option of introducing a mechanism to align the Italian gas hub, the PSV, to the Northwestern gas hub, the TTF, so that the traditional premium that the PSV has had should narrow down and possibly be eliminated over the course of the next months as a consequence of this. There are at the study on the table two different mechanisms. One is a negative entry tariffs at Passo Gries, which is the entry point from the Switzerland border, which effectively would subsidize the import from Northwestern Europe. The alternative, or potentially the complementary measure, is the introduction of a liquidity service managed by the Italian gas TSO, where market participants paid to supply gas at TTF-linked prices and receive a compensation in case there is a spread in place. As you can see, the government is trying to artificially cut the premium. This has potentially a few implications. There is obviously a positive element, which is what the measure is based upon, that it provides the incentive for shippers in Northwestern Europe to export more gas to using the transit gas pipeline, which has a 15 BCM per year capacity. So roughly a bit more than 20% of the Italian gas demand. The downside of it is that there is a risk that the PSB becomes less attractive for the global LNG market. And since Italy has come to rely on almost 30% on LNG to meet the Italian gas demand, these may create a shortage of LNG on the market. So effectively having an opposite effect on the price of the PSB. The explicit position based on this bet is to go long on PSV against the PSB, against the TTF. As for any policy measure, the main risk, the biggest risk here is connected to the nature of the change of the move, which is predominantly is mainly policy driven, and any policy can be easily reversed or scrapped at any time. Additionally, there is a timing risk, which is quite important given the uncertainty around the measure and its timing and how this might play out in 2026. So different types of risk, as I said, are probably riskier than the others, but again, something that we've been asked and discussed with a few market players. That's it for this episode. We've gone through a few ideas that are being discussed, and we are discussing with a few players. Hope that it was fun and a little bit more insightful compared to others. If you want to know more about what we're doing on Energy Foresight and how we translate, our insight into discussions with Marketplace, feel free to reach out and prepare for the next episode, which is the closing one for 2025. To the next one. Bye.